Chapter 4 is called Completing the Accounting Cycle. And it's really about the very last thing that a company does at the end of the year. And we do it early in the class. I mean, really, essentially, the way the structure of the course works is the first 4 chapters kind of introduce accounting, introduce different types of journal entries, and just kind of provide a survey for accounting for a business. And then essentially every other chapter essentially covers some other part of that, just starts to peel the onion of accounting a little bit more. So this video, or this series of videos, is going to cover closing entries, the concept of temporary versus permanent accounts, the actual closing entries and what they are, and then we're going to just take a quick snapshot of what things look like once we're done with closing entries, and then we're going to finish up with the talk of financial statements. Remember, we talked about this earlier, but the exam has financial statement preparation on it, where you have a list of accounts and you have to prepare the financial statements. So we kind of go through that again and wrap back to that again. So why do we have closing entries? This is the first place we start here. And I want to make sure I present these two definitions. I don't think it's necessarily helpful to flashcard or memorize the definition of revenues and expenses unless you're particularly having trouble keeping those straight, keeping your expenses separate from your liabilities or something like that. For the most part, this is just part of the accounting language and lingo that should become second nature to us. But I don't recall, or I don't think there's any specific questions on the exam where you have to actually define revenues or expenses. You will need to define, identify an account as a revenue or expense. I know we've talked about this before, but there's a list of accounts and you have to identify asset, liability, revenue, equity, expense. You have to do that a bunch, but there aren't any which of the following is the definition of a revenue on the exam. All right, so really why we're here is to discuss the difference between a temporary account and a permanent account. And the way I kind of approach that is, imagine a company that's existed for 100 years. And there's plenty out there. You can look, do a Google search, companies that have been around for 100 years. And their accounting has probably been around for 100 years also. The history of the accounts are, in some cases, 100 years old or older in some cases. Let's talk specifically about revenue and expense accounts. And what would happen to those accounts if a company's been around for 100 years? Because all we've done so far in this class is we've just credited revenues every time there's revenues. And so that revenue is just going up, 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 up. Expenses, same thing, where every time there's an expense, we're debiting, debit, 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 up, 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 up. Expenses are going up, revenues are going up. With no check on those accounts, they would go up forever, to infinity, essentially, right? There would be no limit to them. And so what was designed or created in the accounting process, was this closing process. And these accounts, the revenues, expenses, and dividends, are temporary accounts in that process. And you'll see what that means shortly. But for now, I think it's important for you to be able to identify the temporary accounts, revenues, expenses, and dividends. Those are temporary accounts. And the opposite of a temporary account is a permanent account, or everything else. Assets, liabilities, and equity are permanent accounts. And I think this should make some intuitive sense to us. If our bank account had $10,000 on December 31st, on January 1st, it probably has $10,000 in it still. Typically not many transactions happen on that December 31st timeframe. And so hopefully we can see, and it starts to make some sense to us, that our cash, accounts receivable, our fixed assets, these are all permanent accounts, as opposed to the revenues and expenses, which we have to reset. Excuse me. New accounts that we're going to cover in this chapter. The first is not really new. We've talked about retained earnings. I mentioned in the last chapter that unearned revenues is one of those accounts that even to the end of the semester, students were still missing that question. The last exam, they're missing unearned revenues. Retained earnings is another one that students miss all the way to the end of the semester. Retained earnings is an equity account. The purpose of retained earnings is to do what it says, which is it's to show the retained earnings. And so the pluses in this account are net income, and the minuses are dividends. It's a natural credit balance. See the plus over here on the credit side? It's a natural credit balance. And so decreases are going to be with debits. Another new account is income summary. This is an entirely new account. And income summary is kind of a interesting case because it's technically, I think, a revenue account, but it's not really a revenue account. It's really an equity account, but it gets closed. You'll see how it works once we look at the entries. But for the purposes of what you need to know about the income summary account, is it's used in our closing entries, and it's basically a temporary landing place for our income. It will summarize our income. We're going to put our revenues in our income summary account, and we're going to put our expenses in our summary account. And so obviously there's always going to be a difference there, and that difference will be net income. And again, I'm hopeful that you'll be able to see that as we go forward. All right, here we go. Worksheet number 1 is our old friends, our list of accounts from chapters 1 and 2 are back, and we're going to re-specify asset, liability, equity, revenue, expense, and we're going to add a designation to that worksheet, and that designation is temporary or permanent. And again, I've said this before, and I'll say it again. I'll probably say it again before the end of the next video. Work the worksheet. Try it out. At this point, this is chapter 4. Our exam is coming up. You should be able to list appropriately every item on that list: asset, liability, equity, revenue, expense. And now with our new temporary and permanent designation, we should be able to add that too. So work the worksheet. If you miss a couple, that's okay. Now you know which ones you're going to miss on the exam if you don't study and get ready. Good luck. See you shortly for the next part of the video.